The Fed is backed into a corner. The market is demanding rate cuts. If the Federal Reserve reacts to the current conditions and drops rates, it shows that they are dealing with a weak economy and weak markets. If they don't touch rates, markets may react negatively because they're not supporting them. They need that constant stimulus. Without the drip, they'll certainly trip. You came here for the truth, so let me unveil that for you. Today we are going to look at a few economic indicators. All of this pulled together really starts to paint an interesting picture of what's happening. We have been told one thing and the reality is very different. If you look at these stats, you can then add them, put the puzzle pieces together and make some sense of it. Let's begin right away. Empire State Manufacturing Index posts its largest ever drop into negative territory in June. I'm just showing you what's happened, and this right here is big because it is literally the largest ever. This article breaks it all down. I'll show you a chart that's associated with it. If you want to know some further details, then scroll down to the bottom, but just a couple points quickly. The New York Fed's Empire State Business Conditions Index took a sharp turn for the worse in June, falling into negative territory for the first time in more than 2 years. It fell to negative 8.6, that's a record decline. They were actually expecting a positive 10. So this was all based on their expectations. It was much worse, and therefore we have a reaction today in the news. Any reading below 0 indicates a contraction in activity. This is obvious to those who have been paying attention. I know you have, but some people out there are still not aware of what's really going on, and this is one part of that puzzle. So this is the chart here, and you can just see that they were expecting a positive 10, and yet it fell down to minus 8.6, showing you that this has been going on for quite a while. You could see the downtrend right here, all the way from basically 2018 all through it and down in 2019. 2019 hasn't been very good, although it's been good for the stock markets around the world, particularly in the United States. It hasn't been so good for the actual economy, the economic indicators that we've been tracking here. This is the chart that just shows you further back, going all the way back to 2002. The contraction that we experienced was similar to that in 2015 to 2016. It also happens to mirror what happened in the financial crisis. So if it continues to fall further, then we know that something is really going on. Here you can see the monthly change, biggest on record, and it just gives you an idea of where this has been going all throughout this period of time. The Federal Reserve can look at this information, it could choose to ignore it. They are trying to make sense of their ridiculous PCE rate of inflation, which hasn't informed anybody of anything since the beginning of time, and yet here they are using it, pointing to it, and they will have to, in fact, start to ease more, and that, of course, is going to create something that the market loves, but it might actually trigger that signal for people that there is in fact a contraction that's happening in reality. Take a look at these 3 different indicators on this chart. You're looking at the manufacturing PMI headline, the PMI new orders, and the business conditions index. All of these have turned down. This has been very, very clear, very present all throughout 2018, all the way into 2019. We've watched this happening in the United States. I've shown you in Europe. I've shown you globally. All of these have turned down now, and it isn't because of one factor. This is many different things that have been piling up, and of course, it's not going to get any better by the Federal Reserve dropping interest rates by a quarter point. We know that already. So this is not going to be good in what we will see in this near future. US cycle indicator, I've shown you this before, just giving you an idea. I think it was Morgan Stanley who brought us this info. The downturn is that red portion that you see right here, and it just happens over and over and over again according to their models, according to their calculations, how things have really come to be over the years. And all of these times we have seen where this has supposedly been a recovery, but in fact it's not looking very good. Okay, so we've had this moment in time where, yes, we are in this recovery phase, but take a look at the actual stats and it's different. It's not what they tell us. So you could see that we've tipped over, according to their stats, into a downturn, but certainly it could turn around. It's never done that historically, but we'll see if in fact this time is different. So the dotted yellow line is Morgan Stanley's leading indicator for earnings, and it just shows you where we could be heading, because this has been very accurate going back into the late 80s on this chart, and that happens to correlate to the actual S&P 500 earnings per share growth year over year, and it looks like it's heading downward. If this is the case, we are definitely coming due for a recession, and only time will tell. I really like this chart. It's something that I've pointed to on a regular basis over the past little while, showing us, number one, the fact that the Fed funds rate, which is the blue line, could never get back to where it was. Also, it gives us the shadow Fed funds rate, which I've shown you here before on the channel also. Basically, what it tells us is that the effect of quantitative easing had as if it was bringing interest rates into the negative. So it was at zero, but the effect of the money printing brought it down to minus 3%. As a result of the winding down of their balance sheet, that minuscule amount, plus increasing interest rates to 2.5%, it has been the equivalent of an increase of 6.25%, and they have actually gone above this range. Historically, that ends up creating a problem. So you can't look at the number necessarily, but when you factor in the shadow Fed funds rate, things that they don't talk about, we certainly are looking like all of this added together spells real trouble. The Federal Reserve isn't going to tell you about what they're seeing here. They're always going to look at the core PCE, they're going to look at unemployment rates, and they're going to present that out there into the public. But behind the scenes, this is the type of information they know very well, and this tells us that we are yet again falling into this down cycle that is inevitable. Even Goldman Sachs is sounding the alarm to clients that technology stocks are overvalued. Now, be very clear about this. They're not saying that they should sell all of their tech stocks, get rid of them all. They're saying it's overvalued. And what do you do in that case? You take some of the money from these overvalued stocks and you put it into something that is undervalued. The valuation for growth stocks is high, and software in particular now carries the highest multiples since the tech bubble. I'm going to show you a chart on that in a second. Rising market concentration in the political landscape suggests that regulatory risk will persist and could eventually weigh on companies' fundamentals. We've talked about this before. They're saying they're going to regulate the tech companies. I actually think in the end, it's going to be more positive for the stocks. This is only going to make them bigger and more powerful, because nothing they ever do actually benefits the individual. It's only ever going to be there to make them bigger, to make them stronger, and so on. That's besides the point. This is the chart that goes with that. Software stock valuations stand near the highest levels since the year 2000, just showing you the Russell 3000 software going way above the total Russell 3000. There is a huge bubble today that is present within the technology stocks, and for those who are investing around the year 2000 know exactly what is the result of excessiveness, of the irrational exuberance that we've been told about, that we've been warned about, that people seem to forget over and over again. I'm going to end the video there. If you found it informative, then please give me a thumbs up. When you give me a like on this video, you are supporting me, you're supporting this channel and the truth, so I appreciate that very much. If you went through school and you had a full economic education that taught you everything you needed to know, then you do not need to read these two books. However, if you are like 99.999% of people out there, then these books would be helpful to you. I have people in the financial industry telling me that they read these books and they were beneficial and should be taught in school. So if you want to check them out for yourself, go to Amazon. The link is in the description. This will allow you to actually flip through the pages of the books to see if you like them. And if you want the audiobook, that's available at themoneygps.com. If you want to see some more economic indicators, definitely check this video out. I will put it right here. Click on it and I'll see you there.